Hello everyone and welcome to my channel Lesson Study Station. So today we are going to see about financial derivatives. What are derivatives? How many types of derivatives are there? These all things we'll see in today's session. So let's start. The role of derivatives in finance. First, you must know what is a derivative. Okay, so now you have learned about financial system. Now you know how financial system works. There is a system for everything and how it works. Now you know about that. So let's start. What is a derivative? So derivative is a contract. It is a contract with which buyer agrees to purchase asset on some future date at a specified price. Okay, so there will be a buyer and there will be a seller. So two parties are there, buyer and seller. Buyer can buy a particular asset on some future date at a certain time and at a certain price. Okay, so these contracts, so basically it is a contract and its value is derived from an underlying asset. It is a contract between two parties to do buying and selling, and the value of these derivatives derived from an underlying asset. What is the underlying asset? It can be any commodity, it can be stocks, it can be bonds, debentures, it can be interest rates or currencies. These are the underlying assets. Okay. Now I think you know what is a derivative. Whenever any transaction is done between two parties, buying and selling is done between two parties. So simply buying and selling, that will not come under derivative. But whenever there is a buying and selling and the value of that asset is derived from underlying asset, that asset should be underlying, means it can be either gold, silver, it can be oil, can be shares, debentures. From these assets the value is derived, even interest rate also, currency also. From these underlying assets the value of derivatives is derived. Okay, so that's why it's known as derivative, whose value is derived from something else. Okay, it doesn't have its own value, its value is derived from underlying asset. And these are the financial contracts. Okay, so these are basically contracts. Whenever we do trading, whenever we use derivatives, whenever we buy or sell something, okay, so what happens? Okay, we will get a digital note, digital certificate we will get. There will be an agreement between two parties, between the buyer and seller, and a digital note, a digital paper, a digital certificate will be created. Okay, and that will be there with the buyer. Whenever he wants to, suppose if a person has bought a derivative, whenever he wants to sell that, he can show it and he can sell that derivative. So risk, derivatives help in reducing risk. It is very helpful in reducing risk. How? That we will see when we will learn about the types of derivatives. Liquidity is there, means if we want to fulfill our short-term requirements, we can use derivatives for that purpose. Price is there, means it tells us the accurate price of underlying assets, or if any investment is there, it tells the accurate price of that. Now let's see the types of derivatives. Now after learning about these types, you will get to know so many things about derivatives. Your definition will be clear. What is a derivative, how trading can be done using derivatives. Okay, now let's start with futures. Under futures, what happens? There is an agreement between the buyer and the seller. So buyer can buy, buyer agrees to buy a certain either commodity or instrument. Buyer agrees to buy a certain instrument at a certain future date and at a certain price. Means price and date is already decided before. Suppose today I am doing an agreement in the month of May I am doing an agreement, I am a buyer, okay, so I am doing an agreement with the seller that today after in the next month, in the month of June, I will buy this commodity at this price, at the price which is there today, okay, at the current price. Means the purchasing will be done on some future date, it will be done after 1 month, but the price is decided now only. So that is called futures. That is called futures, means price is already decided that at this price only I will buy it, but not today, I will buy it on some future date. So that is futures. It hedge against price fluctuations in commodity markets. So maybe if today I have already decided that I'll do trading on some future date at this price, but no one knows whether the price of that particular commodity will increase or decrease. So there's a risk, but this is how futures work. Okay, maybe I have anticipated that its price will be increased on that date. So if I have done an agreement that I'll buy it on some future date at today's price, not on that day's price, so maybe I have saved myself from loss according to my anticipation, according to my forecasting. Now options is there. It is also similar to future contract, but there is only one difference between these two. In the futures, what happens? Agreement is done between two parties for buying or selling a particular commodity at a certain price which is decided on the date of agreement. Okay, and on that price only the buyer has to buy that particular commodity. So there is an obligation. Obligation is there. When that date will come, the buyer has to buy it. There is an obligation. He cannot avoid this situation. Means it cannot be like that day, when that day comes, he will say, no, I am not going to buy it. It is an obligation because agreement is already done, so he has to buy it anyhow. But in the options, we have options. There is no obligation. There is a right to buy. There is also an agreement between the buyer and the seller. So the buyer can buy that particular commodity on that future date at the specified price, but he has the option. He has the option whether he wants to buy it or not. He has the right to buy. If he wants to buy, he can. If he don't want to buy, he will not do it. There is no obligation. Only this is the difference between futures and obligation. Futures and options. In the futures, there is an obligation. The buyer has to buy that particular commodity on that future date at that certain price. But in the options, he has the right. So options, in the options we have two things. Call option is there and put option is there. Call option is the right to buy and put option is the right to sell. Buying and selling, both things can be done. Okay, and whenever a person wants to buy, so he can use call option. Whenever a person wants to sell any particular commodity, he can use put option. Now third is swaps. Swaps are there. Under swaps, what happens? There is a contract between two parties and they agree to trade loan terms. Swaps means two parties can exchange their interest rates. Suppose two parties have taken loans. Okay, so they have taken loans at different interest rates. Their interest rates are different. Suppose first one has taken loan on 5% interest, other one has taken loan on 7% interest, but their terms and conditions are different. Maybe 5 years they have taken it for 2 years. Okay, they have taken loan for 2 years and they have taken it for 1 year only. And there are various terms and conditions involved. So basically there are two different interest rates. Two persons are there who have taken loan on different interest rates, so they can swap their interest rates. They can exchange their interest rates. So what happens the moment they will swap their interest rates? So they have to pay each other's interest. Principal amount will remain same. They will pay their loan, only the interest rate is swapped. Okay, that is called swaps, derivative. Now there is forwards. Forwards and futures are same. Both are same. Only the difference is forwards is not a legal derivatives and futures is a legal derivatives. Okay, it is a non-standardized contract. Forward is a non-standardized contract. In the futures as well as in the forwards, there is an agreement between two parties who agrees to buy a particular commodity on some future date at a specified at a certain price, and that price is already decided before. So both are same. Only the thing is, futures, if under futures the parties cannot do any fraud because there is a regulator. It regulates everything. But in forwards there is no regulator. So frauds, there are high chances of frauds. Now in today's time we have futures, options, swaps. Forwards are not there. So it is a non-standardized contract between two parties for buying and selling. I hope the definitions are clear about derivatives. Now let's see. Okay, last slide. This is the last slide. Navigating the derivatives market. How we can do buying and selling in derivatives market. First thing is identify. First, identify what are the instruments available. Whether we have options, forwards, whether we have options, futures or swaps available. Then we can identify that. Then we will analyze in which assets we have to invest. We will analyze, we will evaluate all the options properly, and then we will select the appropriate derivative in which we wanted to invest. After analyzing, we will see which one is the best for us, that we will select, and then we will implement. Implementation means we will either buy or sell that particular derivative. Investment can be done in this stage. And then last is monitor. Then we have to track our performance. We have to track the performance of that particular derivative. Okay, if today we have then we have made agreement on certain terms and conditions, so we have to check that. After regularly we have to check that when that date will come, whether that prices fluctuations are going to work for us or not. Okay, whether it going to give us profit or not, so that we have to monitor. So that's it about derivatives. Thank you and keep watching. Stay connected.